Hi, I'm Keith McCullough. Welcome back. I hope you're having a happy holiday. And at the same time, I want to make sure that you're staying in sync with what Mr. Market is telling you. Over the holiday period, a lot of things tend to happen that people start to forget or not pay as much attention to. And there's a couple things here that I want to point out today, specifically in terms of market expectations and new themes that are potentially developing within the market's message here into the last week of the year. So the first thing that I want to do is look at the S&P 500 itself. So what you can see here is obviously the S&P 500 has had a fantastic year. It's up over 29% for the year to date. But within the Hedgeye process, it is bullish trade, immediate term trade, 3 weeks or less is the duration there. And it's also bullish from an intermediate term trend perspective. So what you can see there is the dotted line. Our immediate term trade line of support is 1817. That's more of a momentum line of support. And then the bigger line of support that really matters is the trend line, of course, down at 1756. So that's what that is. For the month to date, that puts the S&P 500 up about 2%. Now, within that message, okay, you got it. The market's up. The market's been up throughout the year. But what components of the market are up more than that, and what are up less than that? We call these basically positive and negative divergences. In other words, what things are diverging positively and negatively versus your bogey, which is, of course, the S&P 500, which is up about 2%. So let's look at the next chart. And again, this one's a very basic one. So we look at, of the 9 major sectors in the S&P 500, basic materials, XLB is the ETF for that, and utilities, XLU, is the ETF for that. There's a very wide divergence on an absolute basis between these two things in and of themselves. But again, versus the S&P 500, the XLB, the Basic Materials Index, is up 3.8%. So again, it's up 180 basis points more than the S&P 500, which I'll get into why that might be in a second. But moreover, utilities are actually down for the month to date. They're actually down 0.6% for the month to date. So horrible absolute performance for utilities. So again, what we would say here is developing potentially is actually people are starting to bet on inflation expectations rising. In other words, they're buying inflation expectations, they're buying basic materials, and they're getting out of that slow growth stuff, that dividend yield chasing stuff, which is effectively utilities. Now, one other chart that you could look at just to hammer home that point is the CRB index and copper. Now, the CRB index is a component index of 19 separate commodities, and that for the month to date of December is actually up 3.4%. So again, outperforming the S&P 500 by 140 basis points. And then copper, which has had a lot of beta and a lot of move to the upside here for December to date, is up almost 6% for the month to date. So that's where the real action's at. But again, I'd summarize this basic theme that is starting to develop. And again, we're a month into this, so again, it can change. And that's really how my process works. You know, change is something you should embrace. You should be very uncertain about what's going to happen next, but you should be very certain to listen to and respect Mr. Market's macro message. And the message here today is while the market's up a lot, inflation expectations for the first time measured by commodities specifically are starting to rise. So that'll be interesting to watch in the first week and the first month really of 2014 as everything else will be. So again, if you have any questions on this, I'm at Keith McCullough. That's my Twitter handle.